welcome to our Wednesday morning trading session. My name is Eric Senft. I'm going to be your host here this morning. For those of you new to the trading room, welcome. Let me give you a very quick overview of what you're looking at here. This is the diversified trading system. And it's diversified because we're looking at the markets from 3 different points of view. Here, the charts across the top are the Hawk Scalper. Charts through the middle here are the Falcon Swing Trader. And then the charts along the bottom are the Eagle Trend Trader. So as the name suggests, we're looking for scalp trades here, swing trades here, and trend trades across the bottom. The charts that I've got on this monitor, I've got the NASDAQ here on the left-hand side. I've got crude oil on the right. I'm also following soybeans and gold on my other monitor, but I'd be happy to take a look at any market which is of interest to you, so please don't be shy to ask. Regardless of the market we're following, the signals all tend to develop the same way. Namely, we're first going to get a warning dot along with an audio alert, and that's going to be followed by a triangle and a hash mark. That tells us a trade is complete and it's time to make a decision. Not all trades are created equal, however. We're going to be focusing on what we call the high probability signals, and I'll be going through those as the morning goes on. Hopefully we'll be able to show you a couple decent trades, providing the market's cooperating. Yesterday was kind of a funky kind of day. The market made some very pronounced swings rather quickly. This morning we seem to be off to a little bit of a uptick. So here was the NASDAQ yesterday on the Eagle. Like I said, this was the morning session. Just saw some really violent swings, no really clean signals in spite of the big moves, which is rare. But the afternoon session, things calmed down a little bit. We got a decent couple signals here, a trend change, a couple green bar sells. These are both high probability signals here on the Eagle, and you can see that the market finally tailed off, gave us our signal, and then closed somewhere around here, around the 48, 58, 59 area. And a little bit of an uptick through the overnight, through the Asian session and the European session, and we're opening around 48.66, so a little bit of a gap below here. Might see traders try to get into that. Crude oil opening with a much more substantial gap. Crude oil very, very sideways yesterday. All the trading seems to have come through the overnight and the Asian session, the Asian and European sessions, crude oil opening somewhere around here, but already a monster gap below crude oil. So we'll see whether they try to get in and fill that. So just kind of waiting at the moment. Gold, of course, taking a big tumble yesterday for those of you who were following gold. Here's gold on the Eagle. And this was yesterday's trading in gold. What a crazy decline. Right from the London Open, it never stopped falling. Here was the North American Open, and just kept tumbling. Leveled out a little bit toward the end of the session. And now they're actually producing a possible buy signal, if you can believe it. shelf there. And soybeans also really, really sideways. Normally soybeans, this is soybeans on the Eagle also, normally soybeans a little bit more directional once they pick their direction, but very sideways session yesterday, day before. Nice little rally. This is what I mean. Soybeans opened down here, gave us a trend change signal, produced the signal right here. See the warning dot along with the audio alert, triangle hash mark, and never really looked back. And then this was yesterday. They never really committed. So kind of waiting for soybeans to do a little something. All right, while we're waiting for the market to actually give us a signal, let me go over a couple of things here. You're going to notice on some of these tools we have what we call system add-ons. It's essentially a standalone indicator. This is a very popular one, a very helpful one. It's the Ultimate Support and Resistance Suite. It's an assortment of 21 support and resistance lines which are forecast for today's trading. No, they are not pivot points, and no, they are not Fibonacci retracements. If they happen to coincide with one of those, it's really by coincidence and not design. The three lines that you see here, these kind of set the tone for the day. The gold line, that's the median line. That tells us the kind of the balance point. Just above is the primary resistance, just below is primary support. So when the market gets above this range, it tends to be a little bit more bullish. When it gets below this range, it tends to be a little bit more bearish. So right now, the Falcon here just breaking through the primary support. We'll see whether or not that holds. I'm a little suspicious of the buyers this morning, given yesterday's rather strong decline. But the stock indices have been very sideways for the last few days. No, we're not missing anything yet. I'm going to take a moment here and describe the Trade Manager. That's this tool that you see here on the right-hand side. The Trade Manager is it's a very important trading tool. I really cannot overemphasize the importance of this tool. What the Trade Manager does is it controls your risk on a trade. So your risk is set right here. Currently I have it set at 2% of my capital. And there's also a manual mode which will default to this quantity up here. So if you want to, always trade 3 contracts or 6 contracts or whatever, you can set that value up there. But the risk percent mode, what it does is it caps your risk. So whether you place your stops tight, note the risk amount, or whether you place your stops looser, a little bit of a rounding error there, but the risk amount essentially stays the same. It's capped at 2% of your capital. If I set that a little wider or a little looser, you'll see that the amount is more or less the same. But what does change is your quantity, the number of contracts you're trading, which is the exact opposite of what most traders do. And of course, we all know most traders end up losing money. And that's a huge reason why, is they end up risking more than they can afford. Sure, Frank. Frank's asking, can you explain the indicator warehouse mean Renko bars set at 8 ticks? The mean Renko bars, that's the chart style that comes with the DTS system. It's also a standalone system, by the way. If you just wanted to get the mean Renko bars, that is an option. What the mean Renko bars do, a horrible name for a great chart style. I really wish they had come up with a better name for it. Not at all sexy, but the mean Renko bars are a range style bar, which means that they only print when the range has been met. In this case, the range is set at 8 ticks. And the reason it's set at 8 ticks is from an extensive amount of testing that was done in the DTS development. The DTS system was actually rigorously tested for 9 months before it was released, and during that time, the brick sizes were optimized for each of the tools. So for the Falcon, it was found that for 90% of the markets that you're interested in, the 8-tick brick would suffice. Unfortunately, the E-mini S&P, one of the world's most popular markets, is one of the markets that falls out of the parameters of the norm, but we have alternate settings for instruments like the E-mini. Namely, we would have a 4-tick brick. Something about that $12.50 tick value in the E-mini that just doesn't produce enough signals. What you end up doing is you end up with a chart that looks like this, where your day break lines are, you don't have enough activity within the day. So you need to dial down the brick size. The nice thing about the mean Renko bars is that they give you a very good indication of where the buyers and sellers are at. This is sometimes not so obvious from a time-based chart or even a tick chart. But here with the mean Renko bars, you can see it's very plain with the swing lows down here that there's obvious buying support. The swing highs up here, there's obvious selling support. So when the market comes up and produces a breakout like this, you can see, we've got the lower swing high here. The market makes a breakout, we can expect the market to continue higher. So it's very useful that way. When Adam first showed me the mean Renko bars, I was reluctant because I was a 5-minute chart trader. And he said, Eric, you got to try these. So I did. I tried them for a week, and at the end of the week I said to Adam, I don't think I would go back to a 5-minute chart. These are just so clear at showing you the buying and the selling pressure. In fact, one of the key things that we look for on our reversal signals is what we refer to as a test of the extreme. Now, this is nothing new. You would have seen this before. Some people will call this a head and shoulders formation. Some will call it an M, or the reverse would be a W. Some will call it a 1, 2, 3 top or bottom. The concept remains the same, however. In this case, our high is the extreme price. We look for the market to test the extreme and then fail. That confirms that when we get a sell signal, the market is very likely to head lower. And of course, the inverse is true on the downside, where the market comes down, makes this little bounce, and all of a sudden we see this test of the extreme. The market fails and starts to head higher. So once we produce a signal through here, that confirms our buy signal. Again, something that seems to be much more obvious on the mean Renko bars than on other chart styles, such as time-based charts. All right. The other thing the trade manager has here is what we refer to as the profit manager segment. It's an assortment of 16 different stop strategies. They are all customizable. So if you wanted to, currently this is the ATR strategy. If you wanted to make it a little bit looser, a little bit more conservative, you could certainly do that. These blue dots that are printing show you where the trade manager would have managed your stops. So what it does is it actually automatically rolls your stops for you based on your stop strategy. So it essentially means that once this trade is active and once you've enabled your stops, you can go look at other opportunities. You can put that on the shelf, just let it work away, and you can look for other trades to develop. Frank's got good questions here this morning. Frank asked, should we only use these tick amounts or would it work at higher tick amounts? It will work at higher tick amounts as well. And depending on the instrument you're trading, you may need to adjust. So for instance, what I'm getting at is if you're looking at your chart and you're rolling through your chart and you're rolling and you're rolling and you're rolling, and there's no daybreak lines. See, yesterday was an especially busy day. If there's no daybreak lines for like 2 or 3 or 4 monitor breadths, then the brick size may actually be too small. We encounter this sometimes with people who are trading the stock market with the DTS system. Sometimes you actually need to make the brick size larger. What the larger brick size is going to do, though, is it's going to split up your days so that they look like this. So there may be some days within a 24-hour period you may only have 1 signal or 2 signals. And depending whether or not you're awake at that time, you may or may not get the trade. So we try to set the brick size so that you get enough opportunities during the day when you're actually watching the market. But yeah, you can set higher brick sizes, certainly. Frank's also asking, how is the trade manager set up according to one's broker margin, commissions, etc., or does it read from your account? Well, you can do a couple of things. You can force it to you can give it an amount. You can give it an account balance right here. But it's designed to read from your broker account. So it will actually check your account balance, what you have in your account, and then use that to determine what your risk exposure should be. It's a remarkable piece of software. When Adam first told me what he intended to do with it, I said, how in the world are you going to get that programmed for a home computer? This is the kind of stuff that's only done on Wall Street. And, you know, they've got huge computing systems and ultra-powerful computers. And they can do that kind of thing. But no, he pulled it off. Adam likes to brag a little bit, the fellow that he hired to do the programming for this. He actually also programs missile guidance systems for the U.S. government. So you know this programming is tight. Anybody who has to program military application software, you know this programming is really, really tight. The trade manager also has this component down here where you can preset your profit targets. So right now I'm all in, all out, target 1, 100%. But if I wanted to break it up, let's say I wanted to take a third at target 1, and I've preset my target 1 down here, And let's say I wanted to take another third at target 2, and I need to set a target 2. And then let's say I wanted to leave a third on as a runner. And let's say I set my trade like so. You see I've got 3 contracts in, takes profit at target 1, target 2, and the third contract is a runner. Oh, okay, yeah, Frank is saying some brokers have $500 per contract, but others need more per initial contract. Yeah, what you're referring to, Frank, is the margin. So the margin, of course, is what you need to put up as a deposit for your trade. And once the margin is removed, the trade manager will take that into consideration. But yeah, for day trading, most of the margins for at least the stock indices are around that $500 mark, it seems. Okay, relatively quiet start to the day. We did get an eagle signal here out of the open. Yesterday we were discussing taking that first in sync signal with the eagle, weren't we? And I don't know, have we hit our profit target yet on this one? Oh, really close. Just about to kiss our profit target. So that was Russell who was doing a lot of work with this, watching that first signal out of the open, providing it's in sync with your trading band. Here on the Eagle, we have this band, and no, it's not an Ichimoku cloud. And yes, I know it looks like one, but it's not. And this trading band gives us our directional bias. So when it's stacked this way with the soft edge above the hard edge, we're bullish. And when it's stacked the opposite way, we're bearish. Some of our best signals come off of the hard edge. When prices encounter the hard edge, we expect some sort of reaction. And we'll look for a signal there. Here was a nice little trend change. Hard edge bounce came in the middle of the London session. Frank asked, does Trade Manager have a scaling in contracts or pyramiding? No, it tends to, if you're going to use the risk percent mode, it will set your maximum exposure out of the gate. So this is, if I set my stops right here, I can afford 1 contract. Now, I'm currently, trading. If I took this trade here, I'd probably have around $175 in open profit. What I can do is I can roll my stop. Well, actually, I would have already hit my break even, my auto break even. But if I hadn't, I could roll my stops here to break even. And then I can place another order. Let's say I want to place another order to enter above what is starting to look like a swing high. So I could do it all over again for the same risk amount, more or less, right? If I entered a new order here, I would now be long 2 contracts. One of the contracts, or both my stops would be here. One contract would be a break even. The other would have approximately $200 at risk, which falls within my risk parameters. So you can manually enter additional contracts, just by right-clicking on the chart and adding contracts in that way. Or if you intend to scale in, you can always start with the manual mode and set your initial exposure, say at 1 contract, knowing that you can maybe afford 2. And then what you would do is you would manually enter your trade. I can't do it here because, well, I guess I can. We'll use a different order. So you can enter the one trade manually there, and then again, just manage your stop. You could have your trade at break even now, and then once again, manually put in an order to enter above the high. So there are options, but no, it doesn't automatically scale in. The risk percent mode will leverage you to the max to start. And the idea behind that is that you also maximize your profit. Right? We've all heard that expression, cut your losses short, let your profits run. Great advice. Too bad nobody tells you how to do it. Well, here the trade manager does that for you in a very effective way. So here was actually a first micro-macro cross signal, one of our high probability signals. And what the trade manager does, let's say I set up the trade, well, let's do it, we'll do the extreme example. So the trade manager leverages me, this is my max exposure. So don't freak out if it seems like a lot of money to you, or don't freak out if it doesn't seem like a lot of money to you. This is 2% of my capital. So I can take this trade, I'll have $420 at risk, and if I hit my profit target, I've made $350. So the idea is, if this trade goes sideways on me and stops me out, I haven't lost more than I can afford. I've lost 2% of my capital. So I'm trading a $20,000 account, that's a $400 hit. That's not going to ruin me. Unpleasant? Yes. But it's not going to ruin my account. I come across people all the time who are trading a $10,000 account, and they'll have, well, it's like my very first trade ever. I was trading, what was I trading? I started with a $5,000 account. This was still when $5,000 was enough money to trade with. And I think I had $2,500 at risk in my very first trade. So I was risking half of my capital. I didn't need to, but I didn't know any better. Lucky for me, the trade worked out. But had it not worked out, I would have had a very short trading career. So it caps your risk, but it also maximizes your profit. See, what most people do is they go, oh, well, you know, we're going to be careful here. I'm only going to take one contract. Oh, good, I'm only risking $65. Great, good for you. You're only making $50 if you hit your high probability target. So while you may be cutting your losses short at $65, you're certainly not letting your profits run. And there's more to letting your profits run than hitting a runner. You know, we all back in our charts like yesterday, and we look at those huge moves the market was making, and we say, yeah, you know, that's letting your profits run. Well, yes and no. Another way to the whole idea behind letting your profits run is to maximize your profit, right? So this is another way to maximize your profit. Contain your risk, maximize your profit. So realistically, I probably would have had my stops down here. My risk amount is an amount I can afford. I'm maximizing my profit. Now, if I wanted to put a runner in, that's easy enough. I'll just take half my profit on target and leave the other half in as a runner. So the market goes up, I hit my profit objective. I could enable, say, an ATR stop, and I could be in this trade still. So my ATR stop would still be running higher. Maybe now I'll go to something like a parabolic, try to protect a little extra profit, and now my parabolic stops are right there, and I think I just got tagged, or if not, very close. So I would have made $50 on one contract and about $65 on the other. So squeaked a couple extra dollars out of the trade. So there's options. There's lots of ways that you can look at taking these trades or customizing these trades to suit your own preferences. Good questions, though, Frank. Thanks for asking, because it helps pass the time when the market's a little bit flat like it is right now. We're kind of wandering a little. We did hit our early profit target, I think. I think we just saw it tick up and hit that. Yes, it did. So I'm going to look at doing that again tomorrow. I didn't do it today, of course, but I'm going to look at that first signal, try to catch some of that early momentum on the eagle. Okay, so we're kind of flatlining a little bit now. We'll see here, there. Oh, we're getting into a macro pullback signal. When the market hits its high probability profit objective, like it just did here in the eagle, so we had our signal here, that was our signal. We just hit our high probability profit target. It's not unusual to see the market react after that. That's what we're seeing right now. Yeah, no problem. Permi asks, I don't know about that eagle trade that you just mentioned. Can you go over it again? Russell, one of the DTS owners, brought this to my attention a few days ago. He said, Eric, you know, that first eagle signal out of the open has been giving me really good results. And so I've been doing a little back testing on it, and I've been watching it live as well. But it tends to develop right on the opening bell or maybe a minute afterwards. We're looking at an eagle signal that's in sync with the band. And it's usually enough to get our high probability profit target. So had we taken the signal, the market makes a little bit of a run up, hits our high probability target. Did it yesterday and the day before as well, and for most of last week. It's seems like it's got very good probability to it. All right, as I guess, the hawk now moving into yellow bars, which is a sign of neutrality and perhaps a trend change building. Don't have a signal there just yet. We do have a red bar buy signal here on crude oil, which we could look to short. The red bar buy is, it's one of those signals, it's a dual signal. So we can look to buy it, or we can look to short the failure. Or we can just use it as an early warning that the market trend might be unwinding. All right, so that's crude oil, possible trade there. And what I'm going to do is, if we get a signal here in the crude oil, if this fills, Normally, I would just take my profit on target, but I'm going to delete the profit objective, turn it into a runner so that I can hopefully show you how the stop strategies work. In fact, let's go with a swing high. There we go. So we'll stay with this trade for a moment. Frank's asking, how is trend strength measured? Well, we've got this handy-dandy little tool down here. Again, this is an add-on, which means it's a standalone. You can use it on any chart, not just the DTS chart. This is called the Trade Forecaster. The Trade Forecaster tries to tell you what the current market environment is and what the next one is most likely to be. So right now, according to the Trade Forecaster, we're in trend mode for about another 20 minutes, after which we're going to be moving into swing mode. So that seems to make sense. We had a little bit of a run up here, so it looks like we're on the tail end maybe of the trend. The Trade Forecaster does not obviously tell you direction. And perhaps the best way to interpret the Trade Forecaster is in terms of volatility. So if we're looking at trend mode, the market pullbacks will be a little bit more subdued. So let's go take a look here at our hawk trade that we're looking at, and you can see the pullbacks very minimal, right? That tends to happen during trend mode. Scalp mode, the other extreme, is where the market, I'm not going to be able to find you one. Well, it's going to have more violent swings. I'm sure we've all seen those. No, I can't find you an example right now. But when the market's in scalp mode, it's going to get a lot more violent swings. Swing mode will be somewhere in between. So what does that tell you? Well, that tells you that if the market is in trend mode, you can probably look for a bigger profit objective. You can probably get by with a tighter stop. Why? Well, because the market's less likely to make a pronounced pullback. In scalp mode, the opposite would be true. You can probably expect less follow through on the profit side, so you probably want to be all in, all out. And you probably need to run a wider stop because the market swings are going to be more dramatic. All right, come on, crude. I'm just kind of floundering here a little bit. Crude inventory, I think, out at the bottom of the hour. They may be stuck until then, but we'll see. Yes, it is a very nice tool. Frank says that's a very handy tool. It is. Oh, and while that was going on, we had a late filter entry signal here on the Falcon. This is one of our high probability signals on the Falcon. The Falcon would pay close attention to this trend line. Here we have a filter that went out of sync and then came back into sync. So the trend line is green. We want to be buying on a green filter. Filter goes out of sync, comes into sync. Trend line never changes color. That's a high probability signal for us. Let's see, did it reach its profit objective? Ooh, it's just almost there. Here on the crude oil Falcon, we're working a little bit of a trend change signal. So the trend line changing color now from green to red. Filter is already bearish. We've got the down move. Now we're looking at trying to fight the market back. If it comes back with another down move, it will print a sell signal. That will confirm our short. Remember how I was talking to you a little bit earlier about the test of the extreme? Well, that we're currently seeing the market trying to retest the high. And if it fails here and produces a short signal, we should see it fall probably here to the median line and maybe even down to the primary support. But crude oil rather sideways here at the moment. If we don't get a decent signal, I will take a trade again just to show you how the whole trade manager deal works. Well, the NASDAQ on a bit of a tear. Soybeans also, they finally committed this morning. So here's our little green bar sell. Remember I said on the Eagle we encountered the hard edge. We produced a signal. I do believe that's awfully close to our profit objective. Not quite, but close. Soybeans very good at sticking with their trend once they get it. If you haven't ever looked at the soybean market, it's a great way to round out your market assortment. Because, you know, a lot of people end up watching like the Russell and the E-mini and the Dow. Well, they all go the same direction, right? More or less. Not soybeans. Soybeans are their own creature. All right, well, we're still just kind of watching and waiting. Bo is asking, hi Eric, do you day trade any other asset apart from crude oil and the NASDAQ? Well, I'll tell you the truth. My favorite is the NASDAQ. That's kind of my pet market of late for the last couple of years, anyways. I like the NASDAQ a lot because it has good intraday ranges, and it's only $5 a tick. So what that means is I can often set a position where I can trade multiple contracts. Right, so I could get in this trade with 4 contracts. That gives me options. I can go all in, all out on target. I can split up the trade, so maybe I want to take half on target, let half run. These are options that I wouldn't have if I traded a more expensive instrument like the E-mini or the Russell. But no, in the trading room, I'll look at anything you want me to look at. This is your trading room. If you want me to show you an E-mini chart, I'll show you an E-mini. I've got gold and soybeans on my other monitor, as I mentioned. Crude oil a little reluctant now, but trying to tick a little lower. My goodness, for those of us who have been watching crude oil for a while, this last year has been torture. It's like a zombie market. It just not moving. Crude oil used to just, you didn't need any caffeine trading crude oil. It kept you awake. Not anymore. Oh my gosh. It's a quiet market. Yeah. Andrew says it won't be quiet in 15 minutes. No, you're probably right. When the crude inventory report comes out. Alright, well, they're trying. Let's see, is it? Yeah, it's only a few minutes before crude inventory. I'm going to leave the hawk trade in play, and what I'm going to do is I'm going to delete the profit target. So we're going to set this up. So now I've got an open target, and we're going to look at the OCO function here on the Falcon. Where's that next zone? There it is. All right. So very often before the crude inventory report, I'll look at an OCO style trade. OCO standing for one cancels other. And it's going to default to this quantity up here. What I'll do is I'll place an order to buy. It's essentially a bracket trade and an order to sell. And what I'm looking to do is try to take the market on a breakout. I'm wondering if that's a little bit tight, if I should go below the median line. Yeah, that looks a little bit better. I know I'm giving up about $300 there in open profit, but I think we'll go with this. Crude oil can be very violent, to say the least. Or, you know what, it's a demo room. Let's make this a little tighter. So we'll use the primary resistance, we'll use the secondary resistance as our entry points, and let's see what about our stop. Maybe we'll go with something a little bit more aggressive. Sure, let's go with parabolics. So what the OCO order does is it it stands for one cancels other. So if we fill to the short side in another 10 minutes, it will automatically cancel the buy order. And because I have my trade manager enabled, it will also automatically give me a stop loss. Yeah, I hope not, Andrew. Don't jinx me. Andrew says your NinjaTrader's going to freeze, and then when it comes back to life, it's going to move 50 ticks. So this is not the ideal OCO type setup that we're looking at here. If you're looking for a trade to follow me on, this is probably not it. But we'll see how this unfolds. We got a few minutes to wait still. Everything else relatively quiet. Oh yes, of course. Dan says, can you show the Geiger counter? Forgot all about the Geiger counter. This is another very nifty tool. It's an add-on tool, which means you can use it on any chart you want. So the Geiger counter is a tape reader, and you're going to see the tape unfold here in a moment. The Geiger counter has that tape component. It has this needle, which tells you the bullish or bearish bias of the tape. It has the current bid and ask, and then it has this nifty little dial around the outside. And this dial, see how it's moving and sticking? When it does that, it shows you a lot of active buying and selling. So when it moves to the green side and sticks and stays for like 3 or 4 or 5 seconds, we see a lot of buying pressure. When it moves to the red side and sticks and stays, we see a lot of selling pressure. Essentially, we're watching the sellers chew through the market or the buyers chew through the market. As a result, we should see a short-term move higher or lower in line with what the dial is telling us. But right now it's fairly balanced. It seems to be pushing back and forth, which is what you would expect going into an inventory report. All right, how are we doing here with the, oops. So we're just about to get a failure signal here on the hawk. Come on. So it's a red bar buy signal. This is currently all the market could muster for a retest of the high. If this bar finishes on the low, it should bring us into the trade. All right, let's go back now to our crude oil. trade, and you can see according to the needle anyways, there's a little bit more of a bearish bias on the market. The other way to trade the crude inventory is to actually allow the market to absorb the information from the inventory report. So about 30 seconds to a minute after the report hits the floor, we're going to get a bracketable range. Frank's asking, does the trade manager have a setting for scalping? Well, our scalping tool is here. It's this one. It's the Hawk Scalper. And what I'm going to try to do is I'm going to try to run this one out. Rather than take a profit on target. I believe the target was 49.34. Something like that. So if crude oil unwinds here a little bit before the inventory report, otherwise I'll show you a scalp trade on the NASDAQ. All right, a couple minutes to go. The Geiger counter pretty well balanced again. You can see the dial bouncing back and forth between the buyers and the sellers. When it pulls and holds like that, that deserves your attention. Oh, they're holding about equal. I was going to say maybe a slight bias to the downside, maybe. Crude oil, of course, has been in a big rally for, better part of a week, I guess. Last 4 or 5 trading days. Frank's asking, is there another tool on the right side showing the bid and ask? Well, on the Geiger counter, we've got the bid and ask. On the trade manager, no, but I'll let you in on a little secret. The trade manager is getting a little bit of a facelift, and I think the bid and ask bar is going to come back. Trade manager used to have a bid and ask bar, but the Geiger counter has it. So you can see the current bid and ask. Oh, lots of buying there on crude. All right, so the inventory report seconds away, and the number is getting a little bit small. We're going to see these jump dramatically here in a moment. Okay, I've got everything turned on, yes. All right, oh, there goes the dial. It's getting crazy now. All right, well, there was your crude inventory report. Isn't that just like crude oil? To unfold all that information within the span of a couple of seconds. What kind of volume was on these bars? Oh, there was some decent volume there. So now that the market's exploded, what you can do is you can actually bracket this range. So our initial order, we were looking to buy up here and sell below the median line. So you could do an OCO order like that. Look at all that volume that went through there. That was bizarre. I think we got tagged on break even. Oh no, maybe not. So we filled our short down here, so we would have easily hit our profit objective. The market bounced back, our stops rolled in at some time here. So yes, we either got stopped at break even, because I was running an auto break even trigger, or we got stopped at the swing high stop strategy. Crazy day for crude oil. That's a typical report release. All right, you wanted to see a scalp trade. Here is a first micro macro cross. Now, this market's getting a little long in the tooth. We've had 3 macro pullback signals within the trend. Yeah, since the open we've had 2. Why is that significant, you say? Well, typically we only see 2 or 3 macro pullback signals within a trend, and then the trend starts to unwind. So we've just got the warning dots. We don't have a signal just yet. Oh, here we go. We could try this one. So we're getting a first micro macro cross on crude. Can I cover it up there? Ooh, I can too. And now this trade has moved into yellow bars. So on the hawk, we actually ignore yellow bars because it's too neutral. So the yellow bar spoiled that scalp for us. Ooh, here we go. So here's the first micro macro cross signal, and I'll cover it there. All right, so I'm going to eliminate the break even and profit targets, and hopefully we'll see a little bit of an uptick here, and I'll be able to demonstrate how the trade manager will actually roll our stops. But as I mentioned, the market may be getting a little bit tired. Maybe one more push back to the 48.90, 4900 area where prices got turned around the other day. Oh, Frank's asking about the current bar. What are those red and green numbers? Yes, I forgot to mention that. This is called the Logic Counter. It's part of the DTS system. It's also an add-on. It's a forecasting tool, which is useful when you're using range-style bars. So what this tells me is I can tell you that the height of this bar, if it finishes to the upside, will be 48.83 3/4. If it finishes to the short side, the downside, the low of the bar will be 48.80 3/4. So it forecasts the range of the bar. Why is that helpful? Well, if I'm printing a warning dot, I know where the signal bar, the one with the triangle and hash mark, should finish, and then I can place my stops accordingly, my entry and exit and whatnot. All right, it's still a little early. I'd like to see a breakout here, but I'm going to enable my stops. Now, when this bar finishes, well, here, I'll accept it now. Watch, Trade Manager is going to pick up my stops. All right, so now Trade Manager has control of my stops. And if this market trades higher, it's automatically going to roll my stops up. There we go. So what that means now is, well, this is a hands-off trade, right? I don't need to monitor this trade anymore. I can put it on the shelf and I can look for another opportunity, maybe go back here to crude oil where we're getting a first micro macro cross now to the upside. So we've got the warning dot, and I can tell you the high of the bar will be 49.81. So the hash mark prints one tick above there. The hash mark will print 49.82. Can I cover it to there? Ooh, I can. All right, so again, I'll disable my break even just so that hopefully I can show you how the stops work. Okay, so these hash marks that you see here, that's the preview function. I'm previewing where my parabolic stops would be. Let's see, where would super trend be at? Oh, super trend would be right there. Maybe the chandelier stop. Yeah, that's a little better. I don't want to strangle the trade to start. Or I can just hold my stops back where they are. Now, normally I prefer to go all in, all out, especially when the market is seeming to be a little more choppy. I do believe we have hit our profit objective on this trade. Yeah. So we would have hit our profit target had I been all in, all out. You can see Trade Manager adjusting the stops slightly. Starting to drag their feet a bit though, I think. All right, I'm going to enable the chandelier strategy. Come on, crude. Lots of hesitation on this bar. All right, and the NQ still kind of floundering here a little bit. I might go to something more aggressive here as well, perhaps the parabolics. Or even the bar high-low, that's even more aggressive still. There we go. We'll just give it that current bar. That's all you get. There's also the break-even function. You can force your trade to break even manually. Well, not a bad morning, but a little bit sluggish. I can't help but think that this morning's opening gap is going to be calling to the market, and we might see a reversal. Frank asks, how do you set an auto break even? When you set up your trade manager, you can go up here, you can enable your auto break even, so you turn it on true. You set your break even trigger distance. So I've set mine at 15 ticks with a 1 tick offset. So that means I'll protect 1 tick in profit. And the trade manager will do that automatically for me as soon as a trade engages. We don't have a signal here. Okay, so we got tagged there on that little bit of a reversal. Close enough to break even, so the market broke down a little bit here after hitting our profit objective. We'll see if we don't get one more trade here. And I'm going to get more aggressive with my stop on crude oil also. There we go. Essentially just give it that bar also. All right. All right, we're going to get looks like we're going to get a red bar buy signal. Ooh, it was trying to give us a red bar buy signal, since turned into yellow bars again. There we go. So we've got the warning dot, we've got a red bar, so we've got a green buy signal on a red bar. That's called a red bar buy. These tend to develop near the end of a trend. So while there might be one more push higher, it's also a signal that we can look to short. Ooh, and there goes the signal. Let's see, are we going to get a second chance? We're working a trend change signal here on the Falcon. So the trend line has changed color. Here's the down portion looking for an uptick. And then for it to come back with a sell signal. Looks like we may try to get into this morning's gap after all, in which case we could see prices trading down here at the median line around the 48.58 area. Things starting to look maybe a touch more bearish. So crude oil just wandering at the moment. All right, this may not be a bad selling opportunity if we get the signal. We're still building the signal. Don't have it just yet. Right, the hawk now moving into yellow bars. We've got the uptick here on the falcon. So the trend line changed color. Here's the down, here's the up, waiting for that down portion to come back. To confirm our sell signal. All right, and we may get a first micro-macro cross to sell in the hawk. All right, here we go. Here's the falcon signal. So we've got the warning dot, waiting for the triangle and hash mark to print. Here it is. So here's the auto break even. I'll show you how that works. I'll eliminate the profit target so that hopefully we can run this out a little bit, and I might be able to show you how the stops roll some more. See, we hit the break even. The stops automatically went from up here down to break even plus 1. Now you can protect more or less. You can protect, well, as many ticks as you want, really, or you even can have a negative break even. By default, it's break even plus 1 tick. And what I do is I set my break even about 3/4 of the way to my profit objective. I figure if it gets, 75, 80% of the way to its profit target and then fails, well, then that's probably a reason just to take a break-even stop out. All right, and that's what we got. So things a little sideways, a little choppy. We're back into the hard edge on the eagle. Right, so whenever we hit the hard edge, we anticipate some sort of reaction. Could be a little flurry of buying show up here, give us our test of the extreme or retest of the high. Perhaps a failure and the market head the other way. All right. Well, we've got a first micro-macro cross building. This is one of our high probability signals. The problem I'm having with this one is, where am I going to cover the trade? Ideally, I should cover it above there. Why so far away, you ask? Well, because it's a trend change, right? It's not going to turn on a dime. The market may well rally back up here to the 48.84 area before it fails. So if I do end up shorting early, because the risk amount does not change, remember, my risk amount is kept constant. I want to give the market a little bit more room to move. Sometimes half the challenge in trading is avoiding getting stopped out prematurely. It's not just finding your profit target, but also not getting stopped out too soon. Frank's asking, does the bottom filter have an audio alert? No, the audio alert prints when the warning dot prints. That gives you time to get to the chart and examine the chart, see whether it's a trade that you want to take. So once this dot prints, I get a scalp warning. I get a scalp alert. And that means I can check all my scalp charts. So I look here and I say, oh, it's the first micro-macro cross signal. I can also check my crude oil and soybeans and gold chart to see if the signal came from there. Some people like to customize their alerts even more so that it will say scalp NQ, scalp CL, trend CL, trend gold, so they know exactly where to look. I never found it that difficult because it's only 4 charts that I'm scanning at any time. Right? If I get a swing alert, there's only 4 charts I need to examine. But you can customize the signal as well, or the alert. So I'm still chasing this first micro-macro cross. Come on. We've broken this little swing low right here. The market should give us one more push lower. So there's push one. Some might count this as push two, but generally speaking, the second leg is a little bit more pronounced. Actually, some people may see this as the first move. On the hawk, you can get as many, I've seen as many as 5 moves in the direction of the breakout, 5 legs. Well, let's see, how many did we have on the way up? So the market broke out here. So that was leg number 1. I'm not sure I would count that as leg number 2. I think I would do that as leg number 2. There's number 3. And you could say 4 and 5, or you could just say number 4. And now it's starting to unwind the other way. So same thing, we've broken a significant swing point. You may count that as number 1. And here we are at number 2, looking for a third leg lower. And it's not Elliott waves that I'm counting, it's just the market will tend to make those kinds of moves when it breaks out. On the eagle, by comparison, we tend to get maybe 2 moves in the direction of the breakout. So here was the swing high, here's the breakout, there's leg number 1, and well, I suppose depending on how you counted, you could count that as leg 2 and there's leg 3, or you may just count this all as leg number 2. Here to the downside, when we broke the support, there's leg 1, and there's leg 2. So when you know to anticipate these things, it can help with your trading as well. It can help you plan whether or not you're going to try to stay with the trade or short it or whatever the case may be. All right, we'll stay with this for a few more minutes. If it doesn't engage soon, I think we're going to button up the trading room, call it a day. If you have any questions or if there's any markets you'd like to see, please type away. So you see, in respect to the logic counter, I've got the warning dot. I know the low of the bar will be 48.73 and a quarter, which means the hash mark will print 48.73 even. I know my entry is one tick lower, 48.72 3/4. It really doesn't matter that much. Mike's asking about this triangle line that's green and then red. That's called our macro line. On the hawk, we have the micro line and we have the macro line. These help give us our directional bias. So not only do we pay attention to the bar colors, but how the prices are reacting to the micro and macro lines. We have this signal. I'll pretend for a moment that these are not yellow bars. That would make a perfect macro pullback signal. The macro pullback signal happens when the market retreats into that heavy line, the macro line, and the micro line changes color. Unfortunately, these bars turned yellow. If they were still green, that would have been a perfect signal. One thing that I will mention, Mike's asking, is it an EMA? No, it's not. It is a moving average derivative, but it's not an EMA. It's actually a customized one. But even though the things you see here on the chart, I know a lot of people are looking at this and saying, oh, well, that's just a moving average crossover system. No, it's not really. ETS system has about a half a dozen algorithms working behind the scenes that have to be met before a signal is even printed. So now we're getting that macro pullback signal. So we'll try to short it from here. What the programmers have done is they've just tried to strip the charts. Well, I'm not going to say strip the charts bare because there's still some indicators on here, but have cleaned up the charts so that visually it's more appealing, and it also makes it easier for you to make a trading decision. You see, you've heard me mention high probability signals all morning. Let me show you an example of what a high probability signal looks like. So, for instance, here with the hawk, these would be the high probability signals on the hawk, the ones that we tend to focus on. So we have things like the first micro-macro cross, the macro pullback, the four-arrow consolidation, the post-consolidation, which coincidentally is, in this case, is also a macro pullback, the red bar buy, or its counterpart, the green bar sell. Right, so these are the signals we're going to focus on. Notice there's other signals printing through here, but we don't pay attention to those because those don't meet our criteria for a high probability signal. So here we are. It looks like we got filled to the short side. And they're hemming and hawing. And that's true for the other tools as well. You know, for the Falcon, there's a lot of programming going on behind the scenes. It's more than what you see here. And likewise for the Eagle. See, we hit that hard edge. Now we're coming out with a red bar buy signal. Sellers are going to have to get busy here. So let's see, where's a reasonable profit objective? Okay, if it fails, if it bounces here off of the secondary support, 48.58. All right, why don't I make that my profit target? So we'll swing for the fences on this trade. Here we go. And I'll engage my break even when we break that low. So once the trade goes live, you can actually adjust all your parameters. I've slowed right down again. I'll try to at least to a break-even situation. Perhaps roll the stops down on the next leg lower. We'll see how it goes. But I think we're going to button up the trading room for now. And if there's no more questions, thank you for your attendance today. I hope you found it a little bit educational at the very least. And I hope it answered some of your questions about the DTS system. If you have any other questions, please don't be shy to ask. You can email me or Adam, and I'll give you our email addresses here in the window. So there's mine, eric@supportandresistance.com, and adam@indicatorwarehouse.com. Permy's asking, can you go over the cheat sheets again, please? Sure. All right, so here are your basic hawk signals. These are your high probability hawk signals that we tend to focus on. Probably the highest, the strongest signal is the first micro-macro cross signal. And it occurs when the micro line crosses the macro line. And it's the first signal where everything is in sync. So that means we have green bars, green trend lines, and a green filter. Everything has to be in sync to make that signal work. Somewhere through the trend, we're going to get a macro pullback signal. Sometimes it develops early, sometimes it actually develops a little bit later. But the macro pullback signal is very easy to identify because everything stays in sync except the micro line. The micro line changes color. After that, the next highest probability signal is a 4-arrow consolidation. In fact, this signal is so strong, it's the only signal I will take off of a yellow bar in the hawk. A 4-arrow consolidation normally has a bull flag or bear flag shape to it, depending whether the market's in an uptrend or downtrend. But sometimes, as it is in this example, it's just a straight sideways consolidation. The market tends to print 4 arrows before its next move. So once we see 3 arrows print, we get really interested in that 4th arrow, because that's when we anticipate the trend to resume. In crude oil and gold, as a matter of fact, we tend to only get 3-arrow consolidations. The market being a little bit more aggressive. After the 4-arrow consolidation pattern, we can look at taking the next signal, which is a post-consolidation pattern. It's kind of like the market showed a renewed interest in the trend. It's going to do it one more time. That's our post-consolidation pattern. In this example, it also happened to be a macro pullback. So it doesn't matter how you interpreted it. You could say it's a macro pullback. You could say it's a post-consolidation pattern. And then last, toward the end of a trend, we'll get the exhaustion signal, the red bar buy. Or in a downtrend, it will be a green bar with a sell signal. And like I said, these tend to develop near the end of a trend. You can buy the red bar buy, expecting the market to retest the highs one more time. Some markets, like the mid-cap, that's the EMD, get very strong follow-throughs off of red bar buy signals. So if I'm trading the mid-cap, I'll usually end up buying a red bar buy signal. However, if I don't think there's enough room here to retest the highs, or that a resumption of the trend is likely, I'll actually set up to short it. I'll look to short the failure. Now you can also use it just as an early warning that the trend is coming to an end. If you've got open profit, maybe you'll bring your stops in tighter, maybe you'll take profit. If the trend fails, we're going to get a first micro-macro cross to the downside, which is the opposite of this. So it's going to be red bars, red signal, but sometimes you can get in a little bit earlier by shorting the failure of a red bar buy. So that's the cheat sheet for the hawk. There's also a cheat sheet for the falcon. And these are your high probability signals. We've got our basic trend change signal. Normally this develops, somebody wrote me the other day and asked, why is the trend change signal developing so late? It happens sometimes. Normally it develops a little earlier. You see these bars here with these wicks on them? This is the market trying to print a trend change signal, but the momentum, the downside momentum was just a little bit too strong. The signal printed a little bit later. It doesn't matter though, it was still a very profitable move. Sometimes it's not important to be the first in line, rather it's more important to be right, even if you're in a little bit later. So the trend change signal on the falcon, a high probability signal. One of these signals, again, we take almost without exception. A late filter entry signal, which I showed you this morning, occurs when the trend line goes, or pardon me, does not go out of sync, but the filter goes out of sync and then comes back into sync. Very important, it has to come back into sync. We print a signal, that's also a high probability signal. And then we have just our basic trend line touch signal, where the market is in a trend, it retreats into the trading, into the trend line bounces it out, produces a signal, and prices continue lower. All right, so those are your basic falcon signals. Then we also have the eagle signal. Now, it took me a long time to find one eagle chart that had all the basic signals on one chart. I haven't printed them off yet, or I haven't labeled them yet, but I can go over them for you quickly. We have the trend change signal. So the trading band goes from bearish to bullish. It's the first signal that prints in sync with the band. Then we have our rule of three signal. The rule of three signal is actually a counter trend signal, and it must be preceded by a retest of the high. It must be preceded by a test of the extreme, followed by a failure. All right, so we've got a bullish band, we're producing sell signals. The market is trying to resume the uptrend, but every time it tries, it heads lower, right? We have lower swing high, lower swing high. We keep printing sell signals. The third signal is usually when the market starts to unwind. And that's what happened in this case. Then we also printed a trend change signal down here to the short side. This one, again, came a little bit late. You can tell from this bar here. This bar was trying to produce a trend change, but it didn't. So had you shorted that, let's see, where was the short? 45.36. You would have been very close to your profit objective on this bar here. But even if you didn't take your profit on this bar, it took a little bit of heat, it looks like it fell off and would eventually have hit your profit objective. Once the trend is established, we look for the bounces off of the hard edge, and in this case we got our green bar sell signal. Now, unlike the green bar sell signal in the hawk, this is actually a very strong signal in the eagle. Like I said, we've got an established trend, the market retraces, hits the hard edge, comes out, produces a green bar, but a sell signal. It's almost like the last chance for the sellers to get their act together. And that would be a strong sell signal. All right, so those are your three tools with your three high probability setups. Now, see here, we're getting a green bar sell now. kind of reinforcing the notion that perhaps the market is going to head lower. Mike is asking, what is the cost of the DTS system? There's information at the Indicator Warehouse website, but it's also a good idea, if you're interested, to email Adam at indicatorwarehouse.com. And the reason I say that is most people, when they're interested in the DTS system, they're also interested in, you know, maybe the support and resistance suite, or the trade manager, or, you know, perhaps the Geiger counter, in which case Adam can bundle a price for you. And it's like everything. It's like the Mexicans like to say when you're on the beach and they're trying to sell you their wares more for less money. But yeah, if you're interested, shoot an email to Adam and he'll be able to give you a package price. Permy asks about the Eagle signals. The Eagle, the rule of three, the three failures, that's one signal. Yeah, after a test of the extreme. Yes, very good, Permy. The second is a bounce. So yes, like a hard edge bounce. And this one happened to be a green bar sell. But any encounter with the hard edge and a bounce out is a high probability signal. The third one is the trend change. So when the band flips over, it's that first signal that prints. And ideally it has this kind of look where the market breaks, it retreats into the hard edge bounces it out. That's showing you some renewed buying momentum after a seller attempt to regain the market. So this one right here, pretty much textbook. All right, boys and girls, I'm going to button up the room now. If you are continuing to trade this afternoon, I can't help but be mildly bearish on the market right now. Don't know if we're going to see a full-blown reversal, but like I said earlier, I can't help but think that opening gap is calling to us. So uh, 13. Okay, Permy's asking, what about the one at 1306? Yeah, so 1306 right here. Yes, that's our rule of three, right? So we've got an uptrend. The market comes down, and it's like it breaks the hard edge and produces a sell signal. Say, all right, well, that can happen. We do produce a red bar buy signal right here, which is the opposite of the green bar sell. That is a high probability signal. You could look to buy that. The market goes up and then it starts to turn. Well, if you're in this red bar buy signal, you're starting to wonder, okay, what happened to my uptrend? The market comes back and produces another break of the hard edge and another sell signal. At this point, you should be thinking, all right, I've got a test of the extreme. We've been unable to continue higher. Now I'm printing a bunch of sell signals. This is not very good for my long position. I'm going to become more aggressive with my stops. I'm going to bring my stops in. So now you're correct. We produce another red bar buy signal. But in light of the failure, this isn't as viable a red bar buy signal. In this sense, it's similar to the macro pullback signal that we were looking at on the hawk. Remember, I told you we normally only see two or sometimes 3 macro pullbacks within a trend. I don't want to see 4 or 5 or 6 macro pullbacks. If it's not to say it can't happen, but I'm going to become a lot more suspicious of it. It's what happened yesterday with the extremely strong rally that we saw. All of a sudden, we're counting like 5 macro pullback signals, and somebody's writing, Eric, it's a macro pullback. Should we buy it? Well, yeah, it's a macro pullback, but we don't see 5 macro pullbacks within a trend. Right? So, yeah, we can buy it, but we really need to exercise some caution. And this is similar. Is it okay to get 2 red bar buys within a trend? Yeah, it is. But this is supposed to be a high probability signal, right? This is supposed to lead to a rally, but it didn't. The rally was rather stifled. Here we're producing another signal. It's supposed to lead to a rally. Well, given that we're producing a lower high, maybe we want to look for a second push on the entry, let the signal engage, let it flinch, and then, look to see if the market regains some momentum. Or dial down your risk amount. Maybe instead of using 2% risk, only use 1%. Or look to enter on a break above this high here. That's a viable entry also. The hash mark is merely a suggestion. If the context of the chart is telling you, or your gut at this point is probably telling you, gee, I don't know about that. Maybe I should hold off a little bit. Your gut is seeing, your subconscious and your gut is seeing something that your brain hasn't caught on with just yet. And that's because we're not seeing the follow-through, right? This is supposed to be a high probability continuation signal, and yet it keeps failing. So on that third failure, that pretty much puts the nix in the wrinkle, as they say, for the buyers. And we see the market unwind from there. Yeah, Permi's asking, would you call that a trend change? Yes, definitely. Absolutely. And the hint that the trend is starting to unwind is this test of the extreme and then the failure. The fact that this signal was not able to take out this high and continue with the trend should have you thinking, I wonder if this trend is starting to unwind. See, we can do the same thing here this morning. We've got a red bar buy signal. The trend is getting tired, right? The momentum has all but evaporated. We're in swing mode for another 13 minutes, after which we're moving into scalp mode. So we get the red bar buy signal. Should we take it? Well, if we're going to take this one, I would take it early. I would take it here. I wouldn't wait for the ATR to flip over. I would not take 2 contracts. I would dial down my risk. And I would take it early so that I had a chance to adjust my trade when this happens. Right? I'm expecting a failure or a possible failure as we get closer to the high. So I want an opportunity to adjust my stop. So if this bar finishes on the high, then I'll definitely roll my stop in below the low. If this bar finishes on the low, well, I may give it one more bar, looking for another bounce off of the hard edge. And let's say it does one of these things. It comes down, it hits the hard edge, it gives me a little uptick like this, and then it starts to reverse. Well, that gives me a chance now to roll my stop from down here to here, and maybe roll my stop to here, or maybe even to here before the reversal. But let's say I left it here, and then the next bar comes and stops me out. So I initially had $185 risk. It looks like I'm getting stopped for about half that. So I'll take, a $90 or $100 hit on the trade if it unfolds this way. However, like I said, if this bar finishes on the high, that gives me an opportunity now to take my stop from down here and roll it up to here. So, all right, so you see it's fighting. The buyers are trying to fight the market back. We saw it flash green there for a second. So they just owe me one more tick, or I may say, you know, screw it, it's close enough. I'll bring it up here anyhow. And in this case, if I get stopped out, it looks like I'll get stopped for, I don't know, a $30 or $40 loss. So again, it boils down to your money management, trying to preserve your capital the best that you can. Without getting yourself stopped out too early, but even if I do take a full stop out here, this is only 1% of my trading capital. That's not the kind of trade that's going to ruin you. That's not the kind of stop out that's going to bust your account. The kind of stop out that's going to bust your account is, you know, if you're trading 3 contracts and you're going to take a $600 hit and you can only afford a $300 loss. That's the kind of trading that's going to ruin your account. And I see it all the time. People who come to me for mentoring and coaching, and they wonder, you know, why can't I make any money? Well, because you're losing more than you can afford to lose. If you cap that, if you get a handle on that, you have a much greater chance of making money. And there's no tool better for that than this trade manager right here. This tool right here is a lifesaver when it comes to trade management. This will do more for your trading success, perhaps, than any other system you can invest in. And I don't say that lightly. All right. No other questions? No? All right. Well, great questions today, folks. I really appreciate the questions. It does help the day go by a little bit when the market's not giving us that many signals. If you have additional questions about the DTS system, please don't be shy about shooting me or Adam an email. DTS owners, I will see you in the trading room again tomorrow morning. And yeah, hopefully we'll have a nice end to the week. It's only Thursday tomorrow. I'm counting on the weekend already. All right, you guys, we'll talk to you later. Bye for now.